Ask me a question.
It's gone on mine now.
Gone.
Yeah. Okay. So we're all live. So we'll give everyone a couple of minutes to join in. Jumping the gun.
How many are you expecting?
There's about 100 in the group now, but it differs depending on like who tend to like change the nights because like everyone's got different commitments on. But we're all recorded and kept in the group, so everyone can just kind of catch up at their own leisure, which is handy.
Wonderful.
So we've got a few joining on now. Hi guys. Evening. Hope everyone's well. We have Nicole with us today. I'll let her introduce herself in a moment. But Nicole is from the Mortgage Advice Bureau. She is an amazing mortgage expert who's helped me personally, but also a lot of KO clients. She's got a really great understanding of mortgages, lending, and everything you need to know. So I was really excited to get her on here and answer all your mortgage questions because I know funding is like a huge part of the investment journey. And it's one of the first places we start because we need to know the budgets. So if you're going down that mortgage route, we need to kind of get that bottomed off first. And it can be a bit of a complex topic and everyone has slightly different needs. So it's great to have Nicole here tonight, and especially after last month. So we had Josh, the accountant, who looked at kind of the business setup. So this follows on really nicely because once you've kind of got that decision in place, mortgage then comes next, because once you've made that decision, it can really help you on your mortgage side of things as well. So Nicole, for the listeners today, are you able to just introduce yourself, please?
Yeah, I think you already that was a really good job already. But yeah, no. So my name's Nicole. I'm a self-employed mortgage broker. I work through, like Kate said, a large network called Mortgage Advice Bureau. So if you have a good look at that online, they're everywhere. They're one of the UK's leading networks. So what that means basically is I have direct access to about over 130 now different lenders, and that's a mixture of your high street lenders that we've all heard of, like your NatWest, your Halifax. Also, we've got broker-only lenders, so people like Accord you might have heard of. So again, only a broker can get those. And there's also specialist lenders in there as well, especially for things like limited company buy-to-lets, or for those who don't have the best credits. Because quite a few, like certain properties as well that crop up are, again, residency statuses, things like that. So we're getting more and more specialist lenders coming through as well, which is great. So we can help those clients as well. So they've won lots and lots of awards as well. So they are literally everywhere. So it's great to work through such a large network like that, because even if I can't help you, I can always try and find the answer or find someone that can and refer you on. So it's a really great kind of network to be under. I've been doing it for a couple of years now. Before that, I was doing customer service. I lived in London for a couple of years, so I know quite a lot of clients come through. KO Estates here are London based, so I do know the London areas. I worked in Harrods for 2 years in management, and then before that I've done random things, like I worked for Pets at Home for years. I was a tyre fitter. I worked behind the bar in Wetherspoons, so I've probably seen some of you on nights out. So I've done all sorts of customer service roles, and that's, to be fair, one of the things that I wanted to bring with me doing mortgages is that it's a scary thing when you go into mortgages. And when I know, for, like I said, for quite a lot of first-time buyers, maybe on this live now and thinking, I just don't know where to get started. I don't know how to approach a mortgage broker. We're not all scary. I think I first always thought a broker would be someone suited and booted who doesn't smile, with pen and paper, and they ask you all these scary questions and say all these words and terminology at you. We're just like, I don't know what they're saying. I'm completely different, so I don't expect you to know anything. Ask all the questions you need to. I work usually over telephone, so I'm usually a telephone-based broker. So again, that avoids all those long-winded face-to-face meetings. I'll do things like this. I can still do Zoom if you want to see who I am. But it just keeps the process nice and simple for you. And I don't use crazy like words for you that you're just not going to understand. I'll talk you through the whole process, and you'll find if you go to direct to a lender and you just use them, they will get you to the point of offer, and then after that they're like, bye, and then you kind of left again to do the next stage on yourself, whereas I will guide you throughout the whole process. So that's kind of one of the things that I wanted to focus on as a broker, and that's what I like to offer. I really like to be there for your first time buyers and just know that I'll guide you through everything, and you're not going to be left. So that's me.
Yeah, no, and it's definitely true, because we always talk about like having the dream team, the people around you that are going to make your life easier, because you can't just invest in property on your own, and you do need the likes of yourself, mortgage advisors, and people to help you along that journey. And it's working with the right people as well, because like I've experienced working with not so great people, and it lets the whole process down, and you just need to build that great team around you. So definitely wanted to share that with everyone today. So we'll dive into some of the questions we've had already, but guys, it can be a really interactive session, so if you have any questions as we go through, pop them in the chat and we can go through those as well, for any issues or questions that you might have. But to start with, Nicole, like one of the very basic questions is, how is an investment mortgage different to a regular or residential? So a lot of people may have been through the mortgage process before to buy on their own, or they may not have. The investment's the first one, but what is the difference between the two?
Yeah, well, yeah, I get asked this quite a lot. And again, when Katie says investment mortgage, some people will call it investment, some people refer to it as a buy-to-let mortgage. And then if you're a regular mortgage, that would be classed as your residential. So your residential basically means it's a property where you will live in. A buy-to-let or investment property is one where you're going to be ideally renting that out, so you won't be living in there. Now, the main difference first is deposit size. So we know now there's the mortgage guarantee scheme with a residential property where you can get a small deposit of 5%. That's all you need. However, with buy-to-let, ideally it's 25% deposit, especially if you're a first-time buyer landlord, it's 25%. If you already own a property, there are some lenders that will do 20% deposits. However, obviously your rates do start to creep up. So if you can get that 25% deposit for an investment, that'd be great. And then, like I said, with residential, it's 5% or obviously lower. That's one of the biggest differences, your deposit size. The next biggest thing is how your affordability is assessed. So I get a lot of you ringing me, emailing me saying, I need to know how much I can borrow. And then my next question will be, well, is it for a buy-to-let or residency? And I'm like, well, does it matter? Well, yes. So with a residential property, so again, one you're going to live in, you are assessed on your income versus your outgoing. So we'll have a look at your wage. That's why I usually ask for pay slips. And then we'll see if you've got any credit cards, any loans. Obviously, if you've got any other properties, if you're not a first-time buyer, lenders will take that into account. We'll run it through an affordability calculator, then I'll be able to tell you what you can borrow, what your max borrowing is. With buy-to-let, however, yes, we still need to know that you obviously earn money and what your outgoings are, because that'll still be assessed and the lender will still need to know that. But it's more assessed on the property price versus the rental income, because ideally your rental income is going to be covering the mortgage payment. So that's what a lender will need to know. So they are assessed differently. However, we still need to gather all the same information. So where they are similar, and again, I get asked this as well. So when people are asking me for an investment property mortgage, whether it's through a limited company or not, why do we need to provide all this documentation? Does it matter? Is it the same for doing it limited or not? So yes, so, and most people know, most people might not know, being a mortgage broker, I'm heavily regulated by the FCA. So we have to get a minimum standard requirement of documents from each of you. And it's not just to make your life hard, it's not to be a pain, and it's because we need to do checks. And it's more because we're doing it for your security and doing it for an easy process for you. So when I ask for documents up front, so I've actually put a list because I didn't want to forget them. I'm just going to go through the basic standard requirements of documents that I would need from you. So whether this is investment or residential, again, whether it's through a limited company or not. So valid ID, residency proof, so usually passport, driving license. Proof of income. Now, if you're employed, it'll be 3 months pay slips. If you get paid things like overtime or commission, I might ask for a P60. However, if you are paid weekly on that, it'll be 13 weeks pay slips. Or if you're self-employed, ideally 2 years tax year overviews, SA 302s. Sometimes we might ask for business bank statements if you've got an already trading company. If it's obviously a new one that you just set up for investing, then no, we won't ask for that. So again, that's just to verify your income. Bank statements, so we'll ask for your most recent 3 bank statements, and this is, we're not being nosy, we don't want to know if you've been to McDonald's or not, so don't worry. I get people panicking going, oh, don't ignore that payment. I don't care about things like that or where you eat. It's more again just to check, because sometimes when we submit things to a lender, we will have to input again any credit cards, loans, so there might be something on there that you might go, oh, I've only got 1-2 payments left, I'm not going to tell her about that, there's no point. But actually it matters, because even if you're going to pay it off by the time the mortgage completes, I need to know that, because if I input your case into the system with a lender, it'll still be showing on your credit file, and if I've not put that in there, they could decline your mortgage, and if I don't have that information, I don't know that, and I'm like, oh sorry, they declined, and we could have missed out on something there. So this is why I asked for bank statements. Source of deposit, so again, if you've got savings, if it's in bonds, anything like that, 3 months again, credit trail. A lot of you as well sometimes might get some money from parents, so it might be a gifted deposit or not. Again, I need a 3-month trail of where it's coming from. So if a lender looks and sees a random 20 grand sum of money just coming to your account, they want to know where that's come from. So it might be that we need to request the bank statements from the person that sent you that money. So deposits are a very big thing. So again, I'm not being hard work when we ask for all these documents on deposits. It's something that you really need to just look into and provide. Things like, again, a lot of you might not be into this yet, but if sometimes you can consolidate debt as well. So things like that will need like credit card statements and stuff like that. But again, I'm not going to go too much into that. But the point of this is that no matter whether you're doing a residency mortgage or an investment mortgage through a limited company, I'm going to ask you for these documents. And until I've got them in front of me, I can't make a recommendation for you. So it's usually, I always say to my clients, it's the hardest part is getting all this information together. And once you've got it, you can sit back and breathe, and I'll do the rest of the work for you. So yeah, hope that sums that question up in a one word.
Yeah, I think that's really important. Actually, the prep is like the most important bit, because I've seen like so many times people dive in and look for deals, finding deals, you find something, and then it's kind of like a race to get all the mortgage through. And realistically, if you're not in a position where you've got your mortgage in principle in place and offer agreed, that process can take quite a while to even just get all the documents, and then you've got to find the right product, and then you've missed the deal. And it's such a shame, because you work hard to get these deals that we want to make sure we're securing it. So that's why we do all this work up front, kind of before we even start the search, to stop that happening. I had a client today whose mortgage offer was like pulled away literally as we were completing, and it's like the worst thing. And it must have been for a reason, like you said, like something was missing in that application, because it shouldn't have got to that late stage for them to then pull out. So that deal's now gone, and it's a real shame, because we worked hard to get those deals, and then once it's gone, it's just really disappointing. So it is a really key thing to just get that right in the first place, for sure.
Just on the back of that, Kate, as well, just thought I'd add, because I know a lot of you as well asked me, they're like, can I have an agreement in principle? No, like you'll panic, because I know a lot of estate agencies now are like, they won't let you put an offer in, and I get that, that's absolutely fine. But if you've already sent me this documentation, I can get you on like that. The other reason as well why I asked for documentation, so if I go into a lender's system and I do an agreement in principle, they will ask me for certain documents. Now, every lender's different in what they ask for, but if I don't have those documents to hand and they do a check on me, I can lose my license and get fined and actual imprisonment. So this is again why I ask. I'm not being like hard work, but it's my job on the line. And also the other thing is, say for example, I just did a random agreement in principle through Halifax, just to go, oh, there you go, use that. But then we actually didn't end up using them as a lender. You've just been credit checked by that one, and then you're going to get credit check again by another lender. So it's just imprinting on your credit file. So that's another reason why I don't like to just hand them out willy-nilly, because I'm affecting your credit, which again, I put you guys first. I don't want to do that to you. Some brokers don't care, but I won't do that, and that's another reason why. But
yeah. No, really good points. So kind of on that, we did get a question in. For someone who's self-employed and a first-time buyer, what is the criteria to get accepted for the first buy-to-let mortgage?
Yeah, so again, if you're self-employed, ideally 2 years tax year overview, SA 302s. Now, if you're not sure, usually if you have an accountant, because they'll do that information for you, you just say, I'm going to get a mortgage, I need my tax year overview, SA 302s, which is basically to show the tax that you paid and what your earnings are. If If your accountant does that, brilliant. If not, I've got a really handy guide from Aldermore so if you want to do it yourself, I can send that to you. So if you ever ask me for that, that's not a problem. I'll send that over. There might be, again, lenders are changing the criteria all the time. If you've got 2 years, brilliant. I can have a look if you've only got the 1 year, because I know there are certain lenders that will, but I don't think they'll do them for first-time buyer landlords. If you've already got a property, I'll probably be able to do it. But again, I'm not saying never, because they change all the time. So that'll be one of those where if you ask me and you're at that point where you've only got 1 year, I'll do some research for you. Because that's another thing. I don't know all lenders' criteria like that. The whole point of a mortgage broker is we know where to find it and we'll look. So sometimes I could spend all day researching someone's case to try and find the answer to that question, because lenders change the criteria all the time. So there might be a lender that 1 week I'm like, yeah, I can put it through them. And then when I go to put it through, they're like, oh no, we've changed now. But then another lender will crop up and do it. So I'll keep asking those questions. And if I say I can't help you at the minute, I'll always keep your details, because if a lender crops up that can do it, then I'll get back in touch and let you know. But yeah, ideally 2 years, and all the documents I've just spoken about then, that's exactly what you need. But if you've only got the 1 year, can't promise you, but I'll have a look into it, because those specialist lenders might do it off 1 year accounts.
Yeah, and is that kind of the same? So if you're a first-time buyer and you've not actually got your residential, is there any changes there?
Yeah, no, so again, same again, but the only thing is it's more of, again, with your income. So it's a minimum income requirement with that. So most lenders will want you to be earning about 25 grand. So again, as long as you're hitting that, as long as you can prove that over those 1 2 years, self-employed or employed, it doesn't matter, as long as you can prove that income.
Okay, yeah, that's fab. So another question I have as well is the interest only versus repayment. What is the general difference between the two, if people aren't aware? But also, which one would you recommend more for landlords?
Yeah, real question. So the initial one is interest only. You are literally paying the interest off on that mortgage. So say if you've got that mortgage on a 25-year term, the end of that 25 years, that loan that you originally took out, that's still going to be there. Nothing's going to be taken off it, because you've just paid the interest. So what a lender will expect to be your repayment method would be you sell that property and that will pay the loan off. So obviously, if that's the only property you've got, they're going to be a bit funny about that, because usually you would have that if you've got a residential in the background. So anyway, I won't go too into that. But a repayment, you are paying the interest and the capital. So what you find on a mortgage, if you take out a mortgage, you're paying the repayment, you'll see that you'll pay interest over the first few years. Then after so many years, after about 5 years, you'll start to pay the capital. So your mortgage will slowly go down throughout the term, which is ideally what you want, because you want to be mortgage free at the end of it. Now, residential properties, so like I was saying, the one that you would live in, a lender will very rarely let you have an interest-only mortgage unless you can prove that you've got something in the background that will pay that mortgage off at the end. So if your property you're going to live in, they won't let you do interest-only, like I said, unless you can prove you can pay it off. However, investment properties, they will let you do an interest-only, because, like I said, you're not living in that property, so you've obviously got somewhere to live, whether you're renting or whatever. They'll think, well, yeah, actually, because if worst comes to worst, you can just sell that investment property, you can pay off that loan, so they're okay. So your property is a security to the lender. Now, again, it's up to you. So depending again what your property rents out at, but for buy-to-let investment properties, interest only is usually favourable, because if you think you can get an interest only mortgage, say for example, £100 a month, and then your rental income's £500, obviously with other stuff, but roughly you're getting a nice profit there, £400 a month. But if your mortgage payment is on repayment and you're paying more like £390 a month, and you're only getting £400 coming in from your rent, you're not going to make a lot of money, are you? So you've got to think about, how much profit do you want to make on that rental income versus your mortgage payment? If you're not that bothered about making profit, which I don't think a lot of people are when it comes to, a lot of people will be when it's coming to investment, then you could get a repayment and you might only be making £100 a month. But you think, do you know what, I'm paying off the mortgage, I'm getting about £100 a month, I'm happy with that. So just assess it when it comes to it. If you want a big profit, then obviously interest only is the way to do it for investment. But if you're not that bothered, then maybe look at a capital repayment. You can change it as well. So if you started off on interest only for so many years, and you think, do you know what, I've actually got I earn more money now, coming to some more money from somewhere. Do you know what? I can put it on a capital repayment one now. So we'll start to pay off both and bring that mortgage down. Then eventually you could have your own house you live in. These investment properties and all the mortgages are being paid off, which is great. You don't have to sell them. So there's that option as well.
Yeah, no, that's useful to know. And that kind of goes back to the strategy which we did in like our first coaching call, of having that end goal, because everyone's investing in property for different reasons. Some people, like you say, are looking for that cash flow and passive income every single month, and want to get the maximum they can. And for most people, interest only would be the way forward for that. Whereas if you are in it for the much longer term and you're just wanting to kind of let the asset grow and capital appreciation, and you're not too bothered about that monthly income coming in, then as you said, that's a great option too. So following on from that, does the strategy you use affect the mortgage? So I know some people in the group are looking to do a flip, some people are looking to do standard buy-to-let, HMOs. How does it all change within the mortgage, and is that something you have to consider?
It still referring to interest only and capital, do you mean?
No, so just in general now, does the
mortgage?
does the strategy affect the mortgage, depending on what you plan to do with the property?
Yeah, so with flip, to be honest, it's one of those things where I try and stay positive about it, but only because, and this is not a personal opinion, it's coming from because I've got to see everything through the eyes of a lender. Lenders don't like it. So the reason why they don't is because at the end of the day, you're saying to this lender, I want to borrow this large sum of money over this long period. They're thinking, oh, brilliant, I'm going to get all this interest from it, really happy, yeah, let's lend it. However, then you decide to go after 6 months, I'm going to sell it now. And then they've just lost that, obviously, that loan and all that interest. So they don't like it. Obviously, there's things like you've got to consider. So if you've just fixed into a 2-year fixed mortgage, and then after 6 months, you've done a lot of work on it, you think, right, I'm gonna sell this property now and get some money off it. You might have an early repayment charge on that product. So then you've got a nice big fee that's just come off the profit that you've just made on that property. So, and then again, so that's the lender basically punishing you for doing that. Obviously, there are products out there, like you can get some certain trackers and stuff that don't have an early repayment charge on them. So you can do it that way, but lenders don't like it. So you'll find as well that once you've got the mortgage, it'll usually be about 6 months before you can actually do anything with it. And that's not every lender, so every lender's different. So again, that'd be one where if you did say, look, Nick, I want to flip this project after 6 months, when I get a mortgage, so then obviously we'd have the conversation where we need to look at basically that you're not going to pay an early repayment charge, you're not going to get punished for selling it early, and also that you're what was the other thing you were saying? I was saying I forgot what I was saying now. What was I saying?
I think it's important that you go in with the strategy in mind and tell you what your plans are, because those fees, especially when people are working out the flip and you're putting in all your numbers and the building costs, stamp duty, that's something you've easily forgotten because you don't even think, oh, I'm going to have a big, huge bill to pay for leaving my mortgage early. So that's a really good one to remember, especially when you're your numbers.
My other point was that, say if we didn't put you on a fixed rate mortgage and we put you on a tracker, obviously then that's you're exposed then to interest rates going like that. So that's the other thing. So all these things we would need to take into consideration. It's not to say no, but for something like a flip project, especially if it's only a 6-month project, it might be worth that. So when you start to look into things like bridging loans. Now, obviously, yes, a bridging loans interest rates are higher, but they're designed for 6-month quick loans so that you can flip it over. But obviously then you've got to make sure that you can get it done within that 6 months. So that's usually where your bridging comes into versus your mortgage. So anything past 6 months, yeah, definitely start to look into mortgages, but we'll just have to be very careful of what product we select. But anything that's just a short-term quick flip loan, mortgages aren't short-term lending. That's not what they're designed for, and you'll struggle with lenders. And like I said, you'll just get penalised with payments for it. Yeah, so that's flip stuff. With things like HMO, now, first time buyer landlords, you're going to struggle getting HMOs. Now, there's only one lender at the minute that I can find that will actually do it. And there's a lot of they're putting a lot of blockers in. Basically, it's not to say I can't, but it's one of those where they like to see you as a professional landlord when you do HMOs. So they don't like it when you've never owned a property in your life, you've never had an investment property that you're used to obviously managing someone renting a house off you, to then go to doing a HMO where there's quite a multiple amount of people renting. They don't like it. They like you to have experience. A lot of lenders now, again, this might change because the more and more people are doing it, the lenders might go, actually, I'm going to start to do this, which obviously one lender has done it. But again, in terms of like the application of mortgage, it's the same. Interest rates are much higher with HMOs, so you're going to be looking at higher interest rates, definitely. Deposit's still the same, so your 25% deposit, but there's just more checks to be made. So obviously, it depends. If the property's already set up ready for HMOs, you might be looking. It might have gone through. It might have a certificate through the council. You might have tenants in there already, so it might be easy. It might have done all these checks on your electrical things, and obviously with COVID, there's more checks to be done there. However, it's a property you're thinking of converting, you've got to get all that done first before a lender will even look at you. So you're paying all this money potentially on a property that you've got to do, and a lender won't look at you until that's done. So it's, again, HMO can be very difficult if it's a property that's not set up and you're a first-time buyer landlord. If you're an existing landlord and you've been doing it for years, a lender's more likely to go, okay, they've done this before, we can see your portfolio, brilliant, yeah, no, that's not a problem. So it's not to say no, but obviously it's harder to get through. So just be careful with HMOs. It might be worth just looking into starting your investment journey just on that one property first, building up a bit of a portfolio, then going down that route. Because at the end of the day, you want full access to all the lenders. If you're just limited to one lender, you're not going to be getting the best rates, you're not going to be getting the best experience. Whereas if you start to go into it slowly and then you're exposed to all these lenders that will help you with HMO properties, you'll be like, oh, this is really good. Like, look at this rate, this is brilliant. You might build better rather than putting yourself in a situation where you're like, oh, I'm paying all this interest rate, I'm not really making any money, it's really difficult. Just be careful, basically. So, like I said, I can guide you in that when it comes to obviously what you're looking at. But yeah, that's the thing with HMOs. It's just they're not ideal for first-time buyer landlords if you've not got a property in the background, because there's just not many that'll do it. Was there any others that I missed?
Refinancing is a big one as well. If you have kind of like the BRR model on the refinance in mind, does that differ to the strategy that you take?
So it's BRR is very similar. It's another kind of version of a flip project. So again, it's the same thing. It's lenders don't like short-term lending. So, and just again, it's just being careful of that product you pick, because depending on how long you want to take to do it up and then sell it, it's that you don't want to be tied in, do you? So you don't want to make that early repayment charge. So most lenders will like to. Again, they'd like to be own that property for 6 months before you do anything with it. Some will state that on the offer, some probably won't care. But yeah, it's just, again, that's the same thing. So again, the same application applies. It's just, yeah.
Yeah, we had a couple of questions in the group kind of on this subject as well. I don't know how much experience you have in bridging loans, but we've had a question, is it worth doing bridging for a property under 100k?
I suppose the property price, I suppose, doesn't matter too much. Again, it's about the time frame with bridging loans. I personally am not trained obviously in bridging loans. I've got a friend who does do them, so obviously if you need to speak to him, let me know and I'll pass you his details and he'll give you a call and see what kind of products he has available. But it's all to do with the time. I would say if anything it's within 6 months, have a look at bridging loans, because a mortgage isn't really worth it. But if you can't turn that property around in 6 months, then a bridging loan is going to be your worst nightmare, because you're going to be paying through your teeth for it. Because mortgage lenders will quite happily lend you. The minimum loan is usually around 40 grand. They don't really like to lend anything under that. So 100k properties, again, that's fine. It doesn't mean you have to go into bridging. Just make sure obviously it starts when you start to get to your 50 grand properties, you know, that are really obviously need doing up, then that's when you're going to struggle. Just bear this in mind as well. If it's a property which you're potentially going to flip or do up, so if it's an investment property and it's in a mess, you need to spend a lot of money on it, a lender will lend on the property in the current state. So obviously it's going to be low value, it's going to be valued low, but also think about your rental income, because the lender will look at the rental income of what it can currently take. So when I was saying about how your affordability is assessed on the property price versus the rental income, if that property is a mess and you're probably only going to get about £100 a month of how it is, that's what the lender will lend on. So again, just be careful with that. So that's another reason why with flip projects and stuff like that, just be careful how bad the property, like its condition is, because that's what a lender will lend on. They won't think, well, it could look like this. It could, because they won't lend on code, they'll lend on facts.
Yeah. And we've had another question quite similar, and we have touched on it, especially the remortgage element. But someone put in the group today, if you buy a property under mortgage value, but it doesn't require any refurb at all, for example, it's been Part X, can you mortgage at mortgage value, or how long do you have to wait to be able to remortgage?
Yeah, it depends on the lender. So it depends what the lender states. So whoever you've taken that mortgage out with, certain lenders might go, yeah, that's fine. Again, you might have an early repayment charge on there, or some lenders might go, no, you have to wait 6 months before you can do anything with that property. Again, what they will do, so they'll ask questions with this though. So they'll want to know why it was purchased at under market value. So obviously if it was a repo or something like that, there's your answer. But say for example, if you're like, well, I just bought it off a friend like for 10 grand less, and then they're like, well, now you want to refinance it for this, have you got some sort of deal going on where you're then going to give it's part of the money laundering basically checks that they'll start to look into. So you just have to be very careful, and you have to have a good explanation of why it was purchased under market value and why you now want to do what you're going to do. So you're going to get heavily questioned, and again, if I don't have the right answer, if I'm not happy with an answer that a client's giving me on this, I won't touch it, because I won't be part of potential money laundering. Not saying that everyone is, but that's the way a lender will look at it. So that's the way I've got to look at it. But yeah, so it's not to say you can't, but it's all to do with case by case assessment. And again, all lenders are different in what they will accept and what they won't.
Yeah, it's probably if you know that before going into this process as well, you should be just very transparent and clear on exactly the situation, so that you can get the right lender to match with that as well. Because there'd be no point going through all that and you're actually with the wrong lender in the end of the day.
Yeah, exactly.
Another question here we've got. We had a good conversation about it, 'cause it was actually very new to me last time I saw you. So the government schemes, and how does that fit into investment properties, especially with like Help to Buy in the background. I know a lot of people like be putting their money into these schemes with the government, but then want to use it for an investment property rather than, and they're just renting themselves, or they don't want to put it into a home they're going to live in. How is that affected, and can it be done?
No. So I spent probably about 4 days trying to get the answer on this. I went through everyone. So I went through my own compliance managers, lenders, business development managers. I went through Target, which obviously deal with the whole Help to Buy schemes. I went through Help to Buy themselves. So basically, I'll start off with, if you've got your residential property through the Help to Buy, which is obviously where you've put down 5% deposit, and again, whether you're in London or not, you'll put 25 or 45, 35, 45, 35 down. Borrowed from them. If you've already got that in the background of residential, and then you think, right, well, you could have had that for about 3 years or something, and you might have just then been paid inheritance from something, not from something, but you might have just got an inheritance payment, and you might think, actually, I want to buy an investment property now with that money. They still won't let you do it unless you paid off that loan from the government. So if you came into a lump sum of money, they'd be like, no, you can pay off the loan now that you borrowed because you couldn't afford to buy that house full at that time. Then you can invest, so they won't let you. Now, I even spoke to my compliance. They said I could. I spoke to a lender. Certain lenders would. I spoke to Target and Help to Buy, and they said no. If that happens, the client could be fined a lot of money. So again, I've really looked into this. So just be careful who you speak to, because you might speak to some friends. I've seen it in forums. People like, yeah, you can do it. Yeah, you can do it. Well, yeah, you can, from the fact that some lenders will do it, but actually, when you speak to Help to Buy and Target, they could potentially find you if that's found out. So don't risk it. It's not worth the fine. So pay off the Help to Buy loan first, and then you can start then with your investment journey. But yeah, you can't have that in the background. If it's to do with Help to Buy and lifetime ISAs, because I think that's another one. So again, it just depends. This is two different ways. So basically, those ISAs are for buying your first property. So the government won't give you the bonuses on them. Now, I think with your Help to Buy ISA, you can just take the money out. With your, if it's a lifetime ISA, they will give you, it's a 25% penalty to take your money out for other reasons apart from buying a house. I think this to do with if you're ill, if you've got ill health and obviously death and things like that. So they're the only reasons why they'll let you take that money out for anything else other than buying a property. So they won't give you the bonus, but they'll penalise you for the lifetime ISA of taking money out for anything else. So again, just be careful with that. But it's one of them, like you can see it from both sides. I can see it when sometimes people go into these schemes at the start because they can't afford to buy their own property. I think it's a good idea to start saving and getting a bonus, and then obviously circumstances change, you come into more money, then you want to invest. But the government at the end of the day are thinking we're doing it to help people that can't get a property. So if you are there going, oh, I'm just going to start investing, they're like, well, that's not really fair, because you actually wanted to do this they wanted to get you on the property ladder and have your own house. So that's why they won't do it. So the answer really is no. The mortgage guarantee scheme, so the 5% one, that's different. So that's basically if you've got a 5% deposit down on a mortgage, that's something to do with the lender and the government. So that's basically if something happened and you couldn't pay your mortgage, the government support the lender basically. So that's the 5% deposit. So don't worry about that. That's not necessarily a scheme, but things like the Help to Buy scheme, shared ownership, again, all the same thing. You can't invest when you're doing things like that. So yeah, just be careful what your initial property purchase is going to be. If you're going to use a scheme, then you won't be able to go down the investment route until you've kind of cleared yourself out of that scheme.
Yeah, that's really important to know, I think, because there are so many schemes like that available, and they're amazing because like people can get off the property ladder, and at that moment in time, it might be just perfect in your situation, but you don't kind of look into the future. And as you say, circumstances always change. So being aware of that and knowing that the implications of that going forward is good to know. So we've had another question. Can a person take out a buy-to-let mortgage very soon after taking a personal first-time buyer's mortgage?
Oh, so if you've just bought a residential property, then you go, right, I want to get a buy-to-let.
Yeah, is there any kind of time delay in that or any issues?
There shouldn't be, no. Again, I'll just always look at the lender, but no, I've had one the other way around actually, where they've just taken out a buy to let, and then the week after they've messaged when I want to remortgage my residential property now. So no, they're not, because at the end of the day, I would always do it that way around as well. So always make sure you do your own property first, because remember, your affordability is heavily assessed on your income versus your outgoing. So if you've got another property in the background, then obviously you might stop yourself getting your own property because the buy-to-let's like slightly different. So no, there's not. You can do it. A lender might tell you to wait a little bit, but no, it's fine because it's going to show your credit file. There's no issues with that. The only thing you've got to be careful is your 3% stamp duty. So obviously you've just bought one property, and as soon as you buy your second property, you've got 3% stamp duty to consider. So just obviously make sure you've got enough funding for that. With that 3% stamp duty, again, I can't go too much to tax. I'm not allowed really to talk about tax. See your accountant. But if you pay the 3% stamp duty, if you sell that property in the first 3 years, you get it rebated, you get it refunded. So not a lot of people do know that. So there is that as well. Obviously, there's two parts of stamp duty. Don't forget. Obviously, you've got the one you initially pay on anything over 125 and goes up in stages, and then you've got your 3% stamp duty, which only kicks in on your second property and more. That should be the only thing to consider if you're going to do that. Buy a property straight away. Just consider your 3% stamp duty.
Yeah, no, good point to definitely factor in those numbers as well. And I know we've talked a lot about first-time buyers and investors, but for people looking to grow and scale, is there any differences in mortgages? Is there like different products to help you like grow and scale more quickly, or what is the difference, if any?
Yeah, do you know, I'm going to be completely honest here, and I don't have a lot of like experienced landlords where they've got big portfolios at the minute underneath me. I don't. But I was speaking to one of my lenders, BDMs, who basically what they do is, so they you've got, when you apply for them, they'll do like a business plan with you. So they obviously have different investors. They work different. They're not just like a one bank man. So they've got different investors that will invest into your sort of what you want to do. And they'll look at your business plan. So if you turn around and say, actually, this is my plan, I want to scale to this side and this side, they'll work with you to grow that. So yeah, you are technically looked at differently in terms, and they can do it. The process is smoother, so that you might find a building block somewhere. Like KO might find you a set of buildings, a building with a set of like blocks in there where you can obviously buy them all together, so you can do it all at the same time rather than doing one with one with one. They'll do that and get you a rate on that, and obviously the process will be smoother because they'll do everything as one block. So yeah, it is slightly different when it comes to experienced landlords, but again, that would be something that I would have to research at the time, and then I'd have to see what lender has the smoothest process really. But yeah, it can be different, and there can be obviously different scales. And then again, if it's one of those where I can't help you with a certain amount of them, because again, we're restricted in terms of if someone has got a limited company property through themselves and a sole name, and then they start to then go down the limited company route, actually we get blocked. So then you have to be referred to a specialist. So I've got that option as well. So it might be that you have to go to a specialist at that point. But again, that's something I can still refer you to and help you with. So I won't just kind of go, no, sorry, I can't help.
Yeah, no, that's a good point, and want to make sure we're helping every step of the way, because obviously everyone starts with the first one, but look, they look to grow and scale. So it's good having that plan or that knowledge of where next to go. But I mean, more generally, when people are applying for mortgages, where do you see people going wrong when they're looking for finance and lending?
I suppose first thing is probably not knowing what they actually want. So the amount of times I get asked, so should I go through a limited company route? Should I go through this? Or I don't know if I want to buy my own house yet. Have a plan first. Don't rush into something. And so many times people see a property come up for sale, like, no, I want that one, I want that one, I want that one. And then we actually start to break it down, and they're nowhere near ready. So just sit and have a good think about what you want. Are you not that bothered about having your own residential property? And do you just want to think, actually, investment's a way forward, I'm happily renting, and then obviously we can help you down that route. But you just, so many times that people start the investment journey and then they'll obviously struggle then to get their own property, and they'll come into obviously loads of hurdles that way. So first thing is sit and think exactly what your plan is. Like, look at your future plans of property, because you just, that way we can then help you and guide you into the best route into that. Because if you're changing your mind all the time, we could make a wrong decision somewhere, and then that could really mess your plan up. So just have a good think about what you want. So that's the first thing. Deposit's always the next thing. So making sure that you've got the right deposit. So again, investments, always think to yourself, have I got 25% deposit plus all these other fees that I might have? Obviously, if it's a property you're going to live in, you only need 5%, but again, you're still exposed to really high rates. So the bigger the deposit, the better. So save. It's one of my biggest things. Probably another one that's just kind of cropped up lately is your employment. So obviously this is more if you're employed. Obviously, if you're self-employed and you're growing your business, keep doing what you're doing. But if you're employed, a lot of people are changing their jobs. And now I know COVID didn't help and a lot of people had to change, but just be careful, because sometimes, again, people have changed jobs, and then certain lenders, again, will ask you for, some might just want to see your contract that you changed jobs and it's permanent. But then if you're on a temporary contract, that might cut you out of a lot of lenders. If you've not had a pay slip yet, again, lenders might not look at you. So just be careful with changing jobs. I know one client recently, he asked me first, he was like, I'm looking to move jobs and I've just had a job offer. Can I move yet? Because I've just put it. So just check. I'm not going to say I'm going to control your career, but just make sure, obviously, before you do that career move, when you're applying for a property, a mortgage. So that's probably another thing. Just again, watch what you're doing with your job movements, because again, if you're a contractor, not a lot of people like contractors. So sometimes some people might just go and get a job at McDonald's for a couple of months, get 3 months pay slips, and then you've just got some income coming in there, and then you might then carry on doing what you're doing. So just be careful with your income on that one. And then documents, not having your documents ready. So start to get your documents to hand. Start to think, right, I'm going to start getting my bank statements together. I know, especially for a lot of London clients, because I know the feeling when I was living in London. You might have your driving license at one address, and then your bank statements might still be your parents and things like that. So stuff like that, make sure, because again, a lender's going to want to see that where you live is where you live, and then all those statements and documents are all under that same roof. So start to think, right, actually my bank statements, I'll need to put them in my new address, or is your driving license and your passport in date? If they're out of date, we can't use them. So just things like this, we start to get yourself ready, because it'll just set you up right. And that's one of the biggest things, is just prepare everything, and then it'll be an easy process. Where things go wrong is that you're not prepared, and you're not and again, this is what we're here for, is to help you prepare. So if you're not sure what documents you need, again, I can ping them out in an email to you straight away, which is what I do in most of your inquire anyway. I'm like, get these documents to me first, and we'll have a good look at them together. Again, I'm not doing it to be hard work. I'm doing it so that we can build a great foundation, and we can get you a mortgage like that and make sure that you're ready for it.
Brilliant. And is there anything else we can do to put ourselves in the best possible position to get lending? I know a lot you mentioned there, but I hear credit score flying around a lot. Is that something we can improve?
Yeah, so again, that's one of my other things. So when I send you an email, usually I'll ask you to. So again, it's completely free. Obviously, if you make sure you follow my steps, it's free. If you don't follow my steps and cancel a subscription, it won't be. But I'll send you a link of how to do a step-by-step to get your credit report. Now, there's a lot of people. Obviously, there's a lot of free ones. Like, I think, is it? Clear Score's free, but the one I always use is Check My File. Now the reason why I use that, it's got all the credit like panels on one, so different lenders will use different ones. So this has every single one. So sometimes, say for example, if you had a missed payment on something, it might show on one, like it might show an Experian, but won't show an Equifax. So you need to make sure you've got all three. So this is why I asked for Check My File, because then there's another reason why I ask is that the biggest one is phone bills. So the amount of times someone will miss a payment on a phone bill and not know. Vodafone do it to people all the time, and people don't know that they've missed a payment, but it's knackered your credit score, and a lender will pick it up. So I can see these straight away when I see your credit report, and then obviously when I apply to a lender, I can put you on the front like, they had a missed payment for this, but they weren't aware. Actually, they paid it straight away, blah, blah, blah. And the lender will go, all right, Brill, rather than just going decline. So yeah, making sure you never miss a payment. So if you've got a credit card, always pay that. If you've got a loan, always pay it. Things like phone bills, even though we don't ask, the phone bills aren't put onto a mortgage application, make sure you pay them. Utility bills are another one. People that miss utility bill payments, but it does knacker your credit file. If you are quite new in terms of like, you kind of just not long kind of left college or school, you just got your first job, you probably don't have a big credit file, so you might never have had a credit card and never have had a loan. So it's not to say you've got bad credit, but you've got no credit. So it might be worth just taking out a small credit card and just paying it off monthly, just build it up that way. That can really help you get a good credit. Now, don't worry too much about the actual score. So the amount of times people go, oh, I'm at 999, but that doesn't really matter to me. That doesn't mean anything to me. It's when you break it down, have you paid everything each month? Like, what's your current loans? What's your current credit cards? If you've got loads on there, or if it looks like you've been searching payday loans and things like that, like that's the red flags all day long. Obviously, if you've had a missed payment, if you've had a default, so a default's usually after 3 missed payments, you'll go to default. Now, again, there are lenders that actually you can process mortgages through if you've got defaults and missed payments, but when it comes to obviously buy-to-let lenders, we're limited for a start. So when things like that happen, obviously it makes things a lot more difficult. But yeah, credit is so important. And even for people that have kind of just come over to the UK, and a lot of people ask me that are living abroad, can I get a mortgage in the UK if I live abroad? But not unless, if you're not living over here, if you've not been over here for roughly around 12 months, they won't lend to you because you've got to have a UK credit footprint. So that's another reason why getting your credit up in the UK will help you get a mortgage.
No, that's really useful, just even some of those tips to just improve your credit footprint, because it's not something we can see really how well we're doing. So that is something to kind of consider, especially if you know it's something you're going to look at shortly, to kind of get that in progress. But thank you, that was really useful. But That's most of the questions we've had through. If anyone is on the call and wants to ask any more, feel free to pop them in. But is there anything else from you, Nicole, that you'd like to add or share with us?
I think it's more just kind of how to contact me and then what to expect more than anything. Because I know some of you will contact me through KO's website and I'll come through that way. A lot of you are starting to send me inboxes through Instagram, which I'm going to hold my hands up. I'm rubbish at checking, so please bear with me and I will get to you. But I'm sure now I've got my number and my email on my Instagram and my Facebook. So email's usually the best way to contact me, just because when your email comes through, I'll put it into my diary straight away to make sure I contact you. So usually just contact me by email. Obviously, if you ring me, leave me a voicemail, because I'll see a mobile number come up. If I can answer it, I will. But if I can't, leave me a voicemail and I'll get back to you, because my phone gets called by random people, and they're always random mobile numbers that are obviously like trying to sell me something or tell me I need my life insurance sorted out. I'm like, well, I can't, because I don't, because I do it myself. But anyway, just make sure you leave me a voicemail and I'll get back to you. But yeah, what to kind of expect is that I will send you an initial email asking for certain documents and stuff. And again, just send them over as soon as you can, because then I can tailor my advice so much to you then, rather than just kind of ringing and going, oh, I need help with this, and yeah, I've got about this 20 grand this and this and that. It's not enough information to get the right recommendation, because actually I could send you a potential product recommendation, and actually when I get all these documents through it, I'm like, oh, actually you don't fit with that lender, so that was pointless. It's a pointless exercise. So that's why I do it. So you'll get an initial email, send the documents over. Once you do, I'll usually do an affordability assessment for you, so I won't credit check you. I'll have my own certificate through MAB that I can get for you. So then you've got an idea, then so you can start to go, right, brilliant, this is what I can afford. I'll start looking at properties. I'll ring Katie and the team at KO and have a look at what they've got on there as well. And then once you've had an offer accepted on a property, then come back to me. So obviously if it's one where the lender's gone, the estate agent said, no, you need an agreement in principle, we can sort that out for you, because then I'll roughly know what lender we're going to use. So obviously then you come to me, I'll look at the mortgage for you. What I will do is I'll give you an idea of a recommendation then. I'll send it to you usually by email. And if you're happy with that, then I'll issue something called a mortgage pack in the post. So you get a nice mortgage pack that will come through. There's some documents in there for you to sign. It's all highlighted in yellow. So again, don't worry. Some people panic going, oh my God, what is this? It's really easy. I'm hoping it is. Okay, I'm hoping you find it easy. But you've got highlighted stuff of what you need to send me back. There's a free post envelope in there, and there's a checklist on the front. So it'll tell you exactly what documents I need. Now, you might have already emailed some over, which is brilliant. So obviously I won't tell you to send me that stuff over. Once that comes back, I will then make sure obviously I've got everything to hand, upload it straight to the lender, and that's that bit done. Obviously then when the lender starts to say, oh, we need this, I'll have it, because I've already got it for you. So rather than what a lot of brokers you might find are going, can I have this? Can I have this document? And you're like, oh, for God's sake. Whereas obviously I've got everything now, so we don't need to bother you. And then obviously the great thing is then your valuation's booked, and then after the valuation, usually a couple of days, you get your offer letter. Now, some brokers might leave you to it, that's it. That point, obviously, we know at this point as well what solicitor you're going to use. Now, obviously, it might be a solicitor that you already know, which is brilliant, or it might be something that you might want me to obviously source for you, which I can do. Either way, I'll guide you through the legal side of things as well. So obviously, I can't get too involved with it because I'm not allowed to. But what I can do is chase things and make sure, obviously, you know what's going on and they know what's going on. Try and keep it all together, all the way up until completion when you get the keys. And then anything after that, like protection, buildings insurance, landlord's insurance, I can help you with as well. So that's kind of what to expect from me. Again, it's pretty much email, telephone. You can WhatsApp stuff, but again, it's just like people try and WhatsApp documents, but documents need to come through email. Again, more for security. So I've got an encryption system on my computer where I keep all your documents safe. So not that anyone's going to come in and pick up my computer and take it, I hope not. But it's all encrypted. So no, so when you start sending things over WhatsApp, it's not secure. And I just feel like anyone could take that phone and your documents are on there. So please, that's why I'm saying, again, I'm not saying it to be hard work. It's just it's security. Because again, I get checked on how I can compliance handle all your data as well. But yeah, like I said, so I'll try and keep everything as simple as possible. there's no question too stupid. Like if you've asked me 10 times, ask me again if you still don't get it, and I'll try and reword it and make sure you can understand it. Like that's what I'm here for. I'm here to like guide you the best I can, and be available. Like I said, if you can only get to me on weekends, I'll make room for you on Saturdays. If you can only get like speak to me on evenings, I'll make time in the evenings for you. If it's first thing in the morning, I'm up at 5 o'clock every morning because I'm a weirdo. I'll speak to you at 5 o'clock in the morning if you need to. So I'm flexible when it comes to that as well. So that's kind of what to expect from me. And that's the best way to contact me is via email, or just give me a ring and leave me a voicemail if I don't answer. And obviously,
absolutely. We'll leave all Nicole's details in the community, and Nicole's part of the community now anyway. So if there's any questions or any further contact, super easy to get hold of it. And I can't like echo that enough. I've worked with Nicole through a mortgage myself, and it is the easiest process because you literally explain like every single step of the way, don't you? And that's like why I recommend you, and I recommend anyone to you. Very useful. So we'll leave all those details there. And if you are at that stage where you're looking for mortgage advice and you're wanting to get those budgets and mortgage in principle together so that you can start your search, Nicole is there on hand and can definitely help with that. So 100% reach out if you need any more information there. But thanks for your time, Nicole. It's been fab and really interesting. Hope everyone's enjoyed. We will save the video and keep it in the group if you need to catch up or come back to it any time for different questions and stuff. So but lovely.
I can see the group now. I can see all the group and stuff. So if you start to put things in, and like I said, I'm not the best on social media. I go on at random times. So I'll probably reply at like 5 in the morning. But if there's random questions in there, I'll try and answer them in the group as well. Then everyone can see them because usually they are repeat questions. So I'll try and keep my eye out for those as well.
Brilliant. No, thanks so much, Nicole. Thanks for your time and all your advice as well.
Alrighty. Thanks, guys.
Speak soon. Bye.
Bye.